Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis. A warm welcome to Money Talk for Thursday the 23rd of May. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, some US Federal Reserve officials signalled they will be prepared to raise interest rates further if inflation picked up, according to a record of the FOMC's last meeting at the start of May. Various participants mentioned a willingness to tighten policy further should risks to inflation materialise in a way that such an action became appropriate, the minutes published on Wednesday said. Central banks in New Zealand and Indonesia left interest rates on hold as expected yesterday. The Reserve Bank of New Zealand kept its key rate unchanged at 5.5% for the seventh consecutive meeting as inflation fears linger. And Indonesia's central bank also left its key rate unchanged at 6.25% in line with expectations. Falling gas and electricity prices have driven UK inflation to its lowest level in almost 3 years. Prices rose 2.3% in the year to April, down from 3.2% the month before. However, inflation remained higher than the Bank of England's target of 2% and was slightly higher than economists' forecasts of 2.1%. Following the data, traders in swap markets paired their bets on Bank of England rate cuts this year. Markets lowered the probability of a June quarter-point rate cut from 50% to 15%. Chipmaker Nvidia's revenue more than tripled from a year ago. Revenues for the 3 months to the end of April was $26 billion, beating estimates propelled by artificial intelligence chip sales. That marked an increase of 18% from 3 months earlier and a jump of 262% from a year ago. And for the current quarter, it expects revenue of about $28 billion compared with consensus estimates for $26.7 billion. Nvidia also announced a 10-for-1 stock split, as well as raising its quarterly dividend 150%. On today's programme, I'm joined by Andrew Freris, the CEO of Ecognosis Advisory, and Alex Frew McMillan, a freelance writer and Asia columnist for TheStreet.com. We're also going to get an update on Asia's frontier markets with Ruchir Desai of Asia Frontier Capital. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com. And while you're there, please take a look at my daily Asian newsletter if you don't subscribe to it already.
Peter Lewis's Money Talk.
US stocks fell from record highs as traders assessed minutes from the FOMC's most recent meeting and prepared for Nvidia's earnings results. The Dow declined 202 points, or 0.5%, closing at 39,671. It was the Dow's worst session in May so far. The S&P 500 lost 1/3% to end at 5,307. The Nasdaq Composite dropped 0.2% to close at 16,802. Shares of Nvidia were down 0.5% at the closing bell and ahead of its first quarter earnings report. After the results were released, Nvidia jumped 6% in after-hours trading, taking its share price past $1,000 for the first time ever. Treasury prices fell, pushing the yield on the 2-year note up 5 basis points to 4.88%. The 10-year yield was up 1 basis point at 4.88%. The US dollar index rose 0.3% to 104.9 on Wednesday, the highest level in a week. The yen slipped 1/3% to 156.72 yen per dollar. On the mainland, the yuan was unchanged at around 7.24 renminbi to the dollar. Gold prices dropped to below the 2,400 per ounce mark, extending its pullback from the record high of $2,450 on Monday. Spot gold ended the session 1.9% lower at $2,378 an ounce. Brent crude oil settled 1.3% lower at $81.80 a barrel. Bitcoin oscillated around the 70,000 level all day, ending practically unchanged at $69,500. Shares in Hong Kong gave up their gains from Wednesday morning, but were supported as tech companies listed in the city helped the broader benchmark avoid a larger fall. The Hang Seng Index fell 25 points, or 0.1%, to 19,196. Chinese electric vehicle maker XPeng rose over 13% in Hong Kong after reporting a 62% year-on-year jump in first quarter revenues and forecast growth in car deliveries. On the mainland, the CSI 300 rose 0.2% to 3,684. And futures markets pointing to a loss of about 200 points for the Hang Seng at the open should start start the day trading around 18,990. And you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's welcome our Thursday morning guests. We have with us Andrew Freris, the CEO of Ecognosis Advisory. Morning, Andrew.
Good morning.
And also with us, Alex Frew McMillan, freelance writer and Asia columnist for TheStreet.com. Morning to you, Alex.
Top of the morning to you, Peter.
Some US Federal Reserve officials signal that they're going to be prepared to raise interest rates further if inflation picked up, according to a record of the FOMC's last meeting, which was held at the start of May. Various participants mentioned the willingness to tighten policy further should risks to inflation materialise in a way that such an action became appropriate. The minutes of the May the 1st meeting, which were published yesterday, said the summary stated participants observed that while inflation had eased over the past year, in recent months there has been a lack of further progress towards the committee's 2% objective. The meeting followed a slew of readings that show inflation was more stubborn than officials had expected to start 2024. Andrew, the Fed isn't going to cut rates this year, is it?
Absolutely. I don't think there is any novelty in pointing this out. My needle is stuck that we're having an inflation which is 3 point, and the point, unfortunately, the decimals are completely trendless. In other words, it doesn't show that it's going down. It's going up, down, flat, which means that I carry on believing that by the end of the year, the Fed may need to begin slowly move to the idea that 3 is going to be quite a good number. It's not going up, it's not going down, and perhaps throw in the hat in the area where you are not increasing interest rates anymore. It's a very awkward forecast to make because the Fed is not going to easily go around and say, sorry, we're not going to hit the 2% target. But this is going on for so long now that either they're going to really begin to increase aggressively interest rates again, and I don't think they're going to do this, or simply point out that we have had a kind of a pivotal period on the inflation range, and therefore a low 3%, it's quite okay.
There's something quite significant in what you've said. You're saying there that the Fed is basically throwing in the towel on its 2% inflation target.
Well, there are two things here. One is to actually say, yes, we're not going to hit it. And the other hand is to say, yes, we want to bring it down to 2%. And that's 1 full percentage point plus. The April CPI was 3.4. And the CPE was 2.7. So even if you choose the CPE, you need to bring inflation down by 70 basis points. And if you look at CPI, you need to bring it down by more or less 100 basis points. And that ain't happening. And I keep begging myself and the Fed, to show us a table where you have the trade-off between further increases in interest rates and further declines in inflation. And that ain't. There isn't a table like that. I've tried to construct it myself, and clearly it is not working. We got stuck now there. I'm sorry, I don't want to take too much time. I'm sorry.
No, it's interesting what you're saying. Alex, let's get your thoughts on this. Is the Fed going to cut rates this year, do you think?
Well, that keeps being pushed out and pushed out. So every time we sort of make a statement like that, then the situation seems to basically be more status quo, and the numbers that looked encouraging then proved disappointing. I think they probably will cut before the year end. I mean, that's what markets seem to be pricing in, but maybe very late in the year. And it does seem like, that they're not going to get their 2% objective easily. But, I've mentioned this before, but Paul Krugman, Nobel Prize winning economist, wrote a column asking why they're obsessed about this 2% inflation rate, or why many central banks cite that as their yardstick. It's sort of a bit arbitrary, and there's no hard and fast proof that should be the correct number. So Andrew's right that the central bank may, have changed its mind if it's not getting its way. It was sort of in the late 1990s that inflation of around 2% seemed to become the accepted US target, and now it's cited by Japan and, in Britain and so on. Most central banks aim for that. But, around 2%, even as high as 3% should be fine. The fact that inflation is relatively tame compared to the roaring beast that it was after the pandemic is what we should probably be focusing on. And then the flip side is that a lot of people in the US, particularly if they're Republicans, think that the US economy is in a recession at the moment, which it isn't. And there are much more pessimistic views of the US economy than is actually true. Another factor, if you look at consumer confidence or consumer views on inflation, they kind of want prices to revert to what they were like in 2020, which is never going to happen. So that would require massive deflation. Inflation not going up as fast as before still means prices are going up. So eggs and your milk and all these things are still more expensive. And so people point to that and then complain, well, inflation's still rampant, but it certainly isn't. It's just simply not true. But prices don't revert to what they were. So that's where that sort of common misperception comes in.
But people remember where they were at some sort of point in time, which is at the moment a couple of years ago when the pandemic started. People noticed that even though inflation is slowing, prices are still higher than they were 2 or 3 years ago, a lot higher.
That's right. But it would take an absolutely horrendous correction to get them to go back to where they were. We would have to have an enormous recession. Yeah. So, it would be a disaster.
Yeah. And Andrew, I mean, the markets then, if there's not going to be any rate cuts this year, the markets have got to reassess once again because they're still out of sync with that, aren't they? They're still pricing in 2 rate cuts according to the Fed Funds futures markets. Are markets prepared for the fact that there might not be any rate cuts this year?
I have, for a long, long time now, I have given up. I try to avoid, like the plague, of referring to the markets. Or the markets have priced or not priced in anything. I have no idea what are the markets. The market is a group of people trading over their telephones. So now, if the expectations of that is that the Fed is going to cut and they are not cutting, then I imagine at some stage the expectations are readjusted. But I'm afraid I have a deep, profound disbelief based mostly on observed data that markets never price anything in. He says that already has been priced in. Okay, no, it hasn't. It happens and then suddenly, then it is priced in. It's never priced in advance. So if it is correct that they have already somehow priced in advance that the Fed is going to cut interest rates, then the equity markets should have been doing significantly better than they're doing now. And, so if they are not doing this, clearly nothing has been priced in. Okay, they are like us. They are going around with a white stick and black glasses. Okay, tapping along as best as they can. So to cut a very long story short, no, I don't think anything has been priced in or market expectations would need to be adjusted. They will go along till something particularly happens, and then that will need, I don't want to say to a fall, okay, because it's already needing to a fall. I mean, if you look on the daily basis, both the Dow and the SP have not been doing very well. And the same thing with the poor Hang Seng. Oh, it was so sad to hear saying it is the best performance in the last 2 weeks of April. Yeah, I look that, and then I look the prices since 2019. It has gone down and it has never gone up again. It's what we have been saying about inflation. It's not good saying inflation has been decelerating. Prices are nearly double of what they were in X time period. I know it's a little bit garbled version, but it is the reality is one thing, and what we collectively believe to be the expectations is another.
Okay. Alex, what do you think? I mean, presumably, if there's not going to be any rate cuts this year, we're going to see the 2-year yield back at 5%, maybe above it. Again, are markets or investors, whatever you want to call them, are they ready for this? Have they taken this into account?
Well, I do think it leaves Asian central banks in a difficult position because so many Asian currencies are terrifically weak against the US dollar. And so they're having to sort of make decisions that possibly run counter to what they would normally do in order to defend their currencies. So that does affect us quite severely here. And of course, in Hong Kong, it ends up with us having a very strong currency and very high interest rates that we've imported from the US due to the peg of the Hong Kong dollar to the US dollar. So it does make things difficult. You saw Janet Yellen meeting with the finance chiefs of Japan and South Korea, and they issued a joint statement saying that they were concerned about the yen and the won. And but obviously Yellen's not in charge of interest rates anymore. But she, the Fed's not making its decisions based on what's going on in Asian economies, but it does make the situation difficult in Asia, and that's why we saw, Indonesia, which did just leave rates unchanged, but in its previous decision, make a shock move to raise interest rates, that were already very high, in order to defend the rupiah. So you get funny decisions or situations happening. And of course, we have, a really, really weak Japanese yen, and then Philippines peso hit months-long weakness. Many Asian currencies are in a tough spot, leaving central banks in a difficult position.
The Indonesian rupiah, it fell to 4-year lows against the dollar in April, and that's why, as you mentioned, the central bank raised rates to 6.25%. That's a record high for them since this new rate. Anyway, the new benchmark was introduced back in 2016. They left them unchanged yesterday. Although a lot of that fall in the rupiah has since been unwound now, but that's sort of, Alex, as you mentioned, an example really of the difficulties Asian central banks are facing at the moment.
Yes, you could say that they've been successful in that they've stemmed that weakness in the rupiah, but I think a lot of economists, Andrew can probably give a better perspective on it, but were critical of that move and thought it was a mistake, sort of temporarily defending the currency at what cost, to consumers, to household finances. And of course, the Asian financial crisis began because Indonesian companies had a lot of US dollar borrowings that blew out and so on. They're not in that situation now. US dollar borrowing isn't such a severe problem. But still, it was, let's say, an unusual decision that they certainly wouldn't have made if the Fed hadn't been continuing its relatively high rates.
Andrew, your thoughts on that? Did the Bank of Indonesia make a mistake having to raise rates at the last meeting, although they did leave them unchanged yesterday?
Yeah, another aspect of a well-established myth is that Asians, they have got a very coherent foreign exchange policy versus the exchange versus the US dollar. The only country that has that is Hong Kong, full stop. The rest of them have always got the dilemma that you can either fix the price or the quantity, meaning that you can either fix the exchange rate or the interest rates, and not both. And they have clearly chosen, to let the exchange rate take the slack rather than increase interest rates sufficiently in order to ensure that their foreign exchanges have not come down. And the notion that they do this in order to have more competitive exports to United States, in other words, they cheapen their exchange rates in order to export more, is fundamentally flawed because it leaves out the fact that in the process of doing that, they allow their interest rates to be not as high as they should or could have been had they decided to have a conscious foreign exchange rate policy, and that is to follow the US dollar. No, they don't. The only country that does that is Hong Kong. Even in the case of China, that has a guided exchange rate, the renminbi has been consistently weak for nearly 2 years now, and that's very perfectly okay, because the People's Bank of China has hardly raised interest rates. They raised them last time, 6 months ago, by 10 basis points. Yeah, they don't want to increase interest rates, and therefore their exchange rate is going to be weaker. Perfectly all right. It's not a wrong policy. It's a completely consistent policy. Now, if you say that's going to have terrible effects on the economy, then perhaps you can change it, but no, it won't.
I wanted to mention the Reserve Bank of New Zealand because they kept their interest rates at unchanged at 5.5%. But they did come out with quite a hawkish statement. They said that monetary policy needs to remain restrictive to ensure inflation returns to target, and they cited higher than expected CPI. I mentioned the Reserve Bank of New Zealand because they've sort of been a bit of a canary in the coal mine, haven't they, in terms of what's happening globally. They were really the first central bank to start raising rates a couple of years ago, and they did so quite aggressively and for quite a long period of time remained sort of quite hawkish. So, Alex, should we take this as a bit of a warning that maybe, we need to look more closely at what they're doing, because this could be a bit of a warning of what's going on elsewhere, and that other central banks, including the Fed, are going to struggle?
Yes, New Zealand tends to get the new year earlier than everyone else, and it also raised rates earlier than everyone else. Quickly followed, I think, by India, which is also an early mover on interest rates, raising them. So it's interesting. I mean, at least the New Zealand Central Bank has a more flexible inflation target of 1% to 3%. So they may feel a little happier about things than insisting that everything has to be at 2%. I think it's worth watching, although it's a small economy, what the Bank of New Zealand does. Andrew is referencing, I guess there's a concept called the impossible trinity in economics, that you can't have free capital flows while having both a stable currency and an independent monetary policy. And so all of the Asia-Pacific central banks are struggling with this issue, that they want to have free capital flows. Not too many currencies have pegs anymore, hard pegs anyway. So that leaves, something out of their control, whether that's the currency strength or weakness, or interest rates, which obviously the central bank can control. But the Fed keeping rates relatively high is what the Fed needs to do to combat inflation, and it has these unintended consequences for the rest of the world.
And Peter, actually, I like your expression of New Zealand being the canary in the tunnel. Well, there was another canary the size of a small tractor, and that was the Reserve Bank of Australia, who actually their last minutes pointed out that they were seriously planning to increase interest rates. And they have been saying this right, left, and center. And guess what has happened to the Aussie dollar? It weakened. There is no justice in this world, all right? So...
It does seem these Antipodean central banks do seem to be quite hawkish at the moment, don't they? But maybe they're right to be.
Yeah. Australia is one of my absolutely favorite currencies, and I've been proved consistently wrong on that. So I don't know why the love affair goes on. I think it's time for me to get divorced. But one of the problems that the Aussies have is, of course, they don't have a monthly inflation. They have a quarterly inflation. And that, you hear the quarterly, and then you have to wait for another 3 months to find out exactly what's happening. And that leaves me unsatisfied. And clearly, inflation is not anywhere near where the Reserve Bank of Australia wants it to be. And they carry on, they're going back with it all the time. And they say, well, unemployment is okay, but the housing market, but we want inflation. And again, as Alex would have said, the cursed 2%. Okay, and we're not getting it. And if necessary, we'll increase interest rates. They are playing very much an American tune.
Well, there were two things investors and markets were waiting for today. One of them was the FOMC minutes, which we've just talked about. The other one was NVIDIA's first quarter earnings. Well, chipmaker NVIDIA revenue more than tripled from a year ago, beat Wall Street's already high expectations. And it announced plans for a stock split, and it boosted its cash dividend by 150%. Revenue for the 3 months to the end of April was $26 billion, propelled by artificial intelligence chip sales. That's an increase of 18% from 3 months earlier, and a jump of 262% from a year ago. NVIDIA reported net income of $14.88 billion, compared with just 2.04 billion a year ago. And the company's largest and most important business is its data center sales, which includes its AI chips, and that grew 427% from 1 year ago. Alex, and it also gave very good guidance for the current quarter. Expects revenue of about 28 billion compared with analyst forecasts of 26.7 billion. And Alex, we're all waiting to see whether spending on AI computing remains strong. Nvidia seems to say yes, it is.
Yes, I mean, what a success story. And Nvidia's earnings are great. You know, the stock price is rip-roaring. And now they have, you know, they've been forced into this 10-for-1 stock split. So $1,000 shares will become $100 each. But I mean, it's been what's the opposite of a canary in the coal mine? Something that's signaling something very good on AI, and you know, it's the flag bearer for the AI Olympics, and it's just been doing terrific. So there was concern that perhaps, you know, these earnings would show some flagging, and we could expect quite a severe, possibly, market response if Nvidia does have a slightly disappointing quarter. But I mean, they keep outdoing already pretty heady estimates and have done it again. So the share price is up slightly. I mean, what was it, 4 to 6% or so after hours. But it's crazy. I mean, it's up 97% this year already, and 686.2% since October 2022. The shares are up. So really, the success story of the markets, and it has sort of distracted somewhat attention from underperformers of what used to be the Magnificent Seven, such as Apple and Tesla, that really haven't been doing as well as they used to at all. But yeah, everything is about AI at the moment in the market, seems, and that's helped drive, you know, even the Dow, but obviously NASDAQ and then the S&P 500 to these records.
Yeah, it's probably fair to say, isn't it, that Nvidia is the most important company in the world at the moment, certainly in terms of its impact anyway on the markets.
Yeah, and Cisco was in that situation a long time ago. You know, we've had others that didn't, you know, honestly, I mean, obviously Cisco's lasted, but I mean, they didn't last in that position for all that long. So maybe AI would have a better forecast on how long this will last, but you know, you do wonder how long it can continue. Certainly can't see another 686% rally in the shares in 18 months.
And Peter, on top of all this, I have two grouses on NVIDIA. First is I can never pronounce the name of the company properly, and I think that was a big mistake to decide on something that starts with 3 consonants. Okay, it never really helps. Anyway, that's their business or not. There was a very interesting article, I think 2 days ago, on the Financial Times, effectively saying hubris is about hanging in the air, and they focused on NVIDIA, and they focused specifically on the artificial intelligence, of which, having lived through incredibly painfully, I was working for Bank of America at the time, the 2000 boom and burst on the internet. Okay, then it sort of the repetition of the artificial intelligence boom and the fact that not everybody is catching up. And also, I'll open it brackets very, very quickly, and that might be complete ignorance rather than knowledge on my part. The fact that Apple have brought out not computers, but tablets. I thought tablets were already, you know, the millennials will tell you, nobody uses a tablet. Come on now, you use your telephone. Okay, tablets that are AI, let's say, boosted or AI empowered. And when you look at that, effectively it means they've got a small number of software embedded that will allow to do certain things, okay, using artificial intelligence, which incidentally, all of us, we have been using artificial intelligence since computers were invented. You know, that really, really upsets me. Now, artificial intelligence as we have right now, it's kind of artificial intelligence on steroids. It isn't new, okay? It is new in the sense that it has been pushed up, okay, one stage up. I remember mobiles the size of a brick that you have to carry around, and now they are the size of a small wallet. Yeah, huge changes in both in the technology and everything else. And hence the obsessive attention on artificial intelligence and how it's going to change life forever. was effectively a kind of a hubris item as far as NVIDIA is concerned. Again, possibly I'm talking out of ignorance rather than out of knowledge.
Yeah, I think that the change has been that generative AI has become more of a bigger factor, where AI can write and generate things for you and create, what we can say is artistic in inverted commas content, or, copy Scarlett Johansson's voice, apparently. So you do wonder, artificial intelligence is only as intelligent as it's been programmed to do. And basically they've ripped off all kinds of creators, probably including my stories, any story that's been written just about. They've ripped that off. And apparently, if you input, I would like a New York Times style story on the topic of NVIDIA's earnings, it'll generate the New York Times story, virtually word for word. So
Alex,
they're ripping people off, basically.
Alex, my main grouse is my GP. I've forgotten now what it is, the GPT. Okay, unfortunately, I still have the cheap one that stops in the year 21. Okay, well, that's a little bit of an issue. You know what? Each time tell me something about Andrew Freris, it declares that I was professor at the University of Southern California and I died 4 years ago. Seriously, consistently. How the hell can I possibly believe it? Okay. My wife, who is a doctor, he says, can you imagine if I ask what will be a correct dose, okay, or let's say ampicillin on an impacted tooth? And they think some back by saying about half a kilo of that. That will kill the patient straight away. Sorry, I have such little faith on that now that it has declared that I'm dead. And it carries on. I carries on correcting. I said, look, I'm alive. Please correct that.
Well, we don't only have to worry about factual inaccuracy like that. I mean, that's obviously the most disturbing. But I think there's a lot of implicit biases as well, that, if all of the medical information has been generated, for instance, on studies of Western people or of white people, then or the facial recognition has been generated based off Western people, then you get possibly strange results when you try to apply it in Mongolia or Kenya. So there are those concerns that would be very hard to unwind. And obviously, Andrew, we can double check whether you died or not, but, the AI can clearly make horrendous mistakes.
As Mark Twain, he says, the rumors as to my death are highly exaggerated. Yes.
Well, I have to say, Andrew, I really appreciate you coming on to Money Talk every week, despite your demise 4 years ago.
I know.
What an achievement. I mean, Jensen Huang, he described yesterday AI as a new industrial revolution. He said it's going to transform everything, the way we work. It's going to make us more efficient, companies more efficient. It's going to increase revenues. Are we talking about something of sort of in comparison with that? Is it that significant?
It certainly is a powerful force. So, I mean, if you think about Excel spreadsheets when they became a big thing, they were a powerful force. I mean, there's been a series of technological developments that have really helped us. I think AI can be very successful if it's deployed correctly. Obviously, my Google Maps uses AI in a terrific way, but I still have to pay attention as to whether they've reflected the roadworks that I can see with my own eyes in front of me, and not just blindly follow whatever it says on Google Maps, because AI makes mistakes and doesn't always have total information. So you've got to use common sense and human smarts. Machines that have been programmed, again, by programmers who input the information can be tricked if you outthink the programmers, or the programmers have made mistakes. So, there'd be a concern about those kinds of errors filtering their way in.
Yeah, wise words indeed, because the progress of scientific revolutions in the post-war period, and I'm old enough to remember exactly the post-war period, have been a series of improvement, or series of very significant improvement on existing ideas. Okay, genuinely new ideas have been incredibly few. Okay, Those of you watching Second World War movies, you remember the American Marines talking to these colossal walkie-talkies. Well, they were effectively mobile telephones. Okay, except now they are much, much smaller and much, much more efficient. So there was nothing really incredibly new into that. So the serial progression of very small jumps on an upward trend, okay, particularly when you look backwards, gives you the idea that there has been a colossal significant improvement. The answer is no, there have been a lot of small continuous improvements, which one doesn't ignore at all the fact that in 1950 we didn't have internet. But I clearly remember the dawn of the internet. Yeah, well, that was a huge improvement, and it was something that we could not do it before. Okay, but from then on, the variations of that have been, well, anyway, enough of me. Enough already, as they say, yes.
Well, it's a fascinating discussion. I'd love to carry on more. We'll have to do this again in the near future. Thank you both very much for talking with me this morning. You had Andrew Freris, the CEO of Ecognosis Advisory, Alex Frew McMillan, a freelance writer and Asia columnist for TheStreet.com.
Peter Lewis's Money Talk.
I'm joined now by Ruchir Desai, who is fund manager at Asia Frontier Capital. Morning, Ruchir.
Good morning, Peter. Thank you for having me.
You're very welcome. We talk about the Asian frontier markets when you come in. So tell me a little bit about how they performed since we last spoke, which was at the beginning of January. So what's the 2024 performance looking like now?
Yeah, great. Thanks, Peter, for the question. So, I mean, when we spoke at the beginning of the year, Asian frontier markets had a very strong 2023. So many of our markets had a pretty significant run across the board. It was, Pakistan, Sri Lanka, Kazakhstan, many other markets within our universe had, returns more than 20% last year. And that momentum has carried on into 2024. So for the first 4 months, in fact, almost for the first half of this year, Asian frontier markets are amongst the best performing markets globally this year. So for example, Kazakhstan, Sri Lanka and Pakistan all have returns of more than 20%. Kazakhstan's return about 25% in dollar terms, Sri Lanka about 24% and Pakistan about 22%, all in US dollar terms this year. So the momentum continues across the board. Even Vietnam has regained some momentum as well from for the last couple of weeks now. And there are a couple of factors which are driving this rally in Asian frontier markets, and the factors have not changed, which I've discussed on your show previously. One is the global macro headwinds, which were there, for example, in 2022 in terms of a very aggressive US Fed. That has kind of died down. I'm not sure when the US Fed is going to cut. I don't think anyone is sure at this point in time. But in general, the consensus is that the US Fed obviously is less hawkish and getting more dovish, and probably there's a more balanced view out there for global interest rates. And that's very positive for frontier as an asset class for the frontier emerging markets as a whole. So that's helped our markets. But besides the global macro being more benign for our markets, even countries within our universe are doing very well. So for example, or turning around. So for example, Pakistan and Sri Lanka coming out of a crisis now.
It's noticeable, isn't it, that the countries you mentioned, Pakistan, Sri Lanka, they have been in the headlines because of huge economic problems and have needed IMF bailouts. But nevertheless, they're among the world's best performing markets.
Yeah, I mean, exactly. So whenever you have a crisis, I think that's a very good opportunity to look at probably investment ideas in these kind of economies or these kind of situations, because that's when you have the bottom. And Sri Lanka kind of bottomed out end of 2022. Pakistan, the economy and the stock market bottomed out in the summer of 2023 or mid 2023, and that was the time when people are very, for example, and those kind of situations, investors are very ignorant about what's going on. They've completely given up on the market. But I think things start recovering. So both countries, like you said, have got an IMF program. Inflation is coming off significantly. In fact, Sri Lanka's central bank has cut interest rates by 700 basis points in the past 1 year, because inflation is now at about 1.5%. It used to be more than 50% about 2 years ago. It's come down significantly, and same thing in Pakistan. So you've seen that across the board, even Bangladesh for that matter. I think that will be the next kind of country or stock market to see a recovery, because they were the last to enter the crisis, but they've taken some tough measures over the past couple of months, and you'll see some recovery happening in Bangladesh as well, I would say, in the next 6 or 9 months.
So if you look at the markets that have done well in the frontier market universe, Kazakhstan, Sri Lanka, I think Iraq, Pakistan, they've done well. Should you now be maybe thinking, well, the gains for this year are over, that we've seen the best now, and you should start looking at maybe some of the underperforming Asian frontier markets now?
Actually, I don't think the gains are over for the year, because I think this now, in my opinion, Asian frontier markets have entered a period of about 2 or 3 years of strong growth going forward, not just in terms of stock market performance, but also of economic growth. Like I mentioned, many of these economies are coming out of a crisis, so they had 2 or 3 tough years, even Vietnam for that matter, despite all the attention it gets for, getting a lot of foreign direct investments and manufacturing. Actually, the stock market hasn't performed a lot over the last 2 years. So I think the momentum has only begun. And like I mentioned, the global macro headwinds are very favorable for, the global macro situation right now is very favorable for our markets. And also the countries themselves are, cutting interest rates. You're seeing a recovery in earnings and economic growth. And valuations for the matter are very cheap. So valuations across the board, even Vietnam trades at about a P of 11 times on a forward multiple basis, and the other markets in our universe trade at less than 10 times. So you have a lot of tailwinds coming up. So I think the cycle has only begun for these markets. So I would be very bullish on these markets with a 2 to 3 year view from here.
Well, what about some of the underperforming areas like Bangladesh? I think that's down about 10% so far, isn't it? Is that one where you could say, okay, maybe there's catch-up potential here?
Absolutely. So I think Bangladesh has got catch-up potential. As I was mentioning, that was the country which kind of went into a crisis last. They went to the IMF last. They've taken all these tough measures like currency devaluation, raising interest rates, removing subsidies on fuel, doing these reforms, increasing taxes. They've done that only in the last probably 6 or 7 months, compared to, say, Pakistan, Sri Lanka, which have done that for the past probably 18, 24 months. So they've entered the crisis last, they've taken the measures last, and therefore you're seeing, the market getting a bit jittery because of these measures that have come into place. But, you got to give it, if I take an 18-month view from here, I would say we are close to the bottom in Bangladesh as well. And I think Bangladesh can have a pretty good return if I take a probably 12 to 18-month view from here as well.
Now, you mentioned interest rates. The Fed cutting rates is supportive for these markets. What happens to them? How well protected are they if the Fed doesn't cut rates this year? Because we saw the FOMC minutes last night. There is a feeling now starting to appear in markets that maybe this idea of 2 rate cuts is wrong, and we might not get any this year. What would that do for because normally that's traditionally not good for emerging markets. What would it do for these frontier markets?
Well, we've seen this since pretty much all this year. For example, when the year began, or in the first quarter of this year, people were very bullish about Fed cutting more than 2 or 3 times, and now it's come to about 2 times, and maybe even no interest rate cuts. But despite all that, despite this kind of negative news flow coming in, many of our markets have continued their rally. So like I mentioned, you've not seen any major correction or any major disappointments amongst investors, even in the currency market, because even the macro situation in many of the economies is improving. For example, Sri Lanka is seeing they're seeing a large inflow of foreign exchange reserves because of the increasing tourist revenues. Other markets, Vietnam is seeing an influx of foreign direct investments coming in. So their external situation is much better compared to, say, 2 years ago when the Fed was raising interest rates very aggressively. And I think the big picture, I think we should not miss the forest for the trees. The Fed may not cut, may cut, but the big picture is that eventually the interest rate cycle is going to move, and is going to move towards moving down, which is going to be positive for our markets.
I mean, we shouldn't lose sight of the fact that actually some of those markets that have performed best, like Sri Lanka, like Kazakhstan, have also seen some big cuts in their own interest rates, haven't they, over the past 12 months?
Absolutely. Just adding to my point. So even if the Fed maybe doesn't cut, or their expectations they won't cut this year, the situation in many of these economies is much better, and therefore inflation has come down significantly. That's given room for central banks and universe to cut interest rates. Sri Lanka's cut interest rates by 700 basis points, Kazakhstan by about 250 this year, Georgia by about 250. And I think the next, because irrespective of what the Fed does in the next, say, 6 months or 9 months, the next central bank in our universe to cut interest rates pretty aggressively will be Pakistan. I expect interest rates to start coming down by the 4th quarter of this year, and with a 12 to 18 month view, I see them cutting interest rates by about 500 to 600 basis points from here as well.
With interest rates quite high, high compared to where they've been over the last few years, maybe not so high historically, but nevertheless, with the Fed funds rate at about 5.25%, should we be looking at the debt of some of these countries? Because obviously that has an impact, doesn't it, on countries that have a high level of external debt. Are there any countries there that we should be concerned about?
Yeah, so many of these economies, the issues they've had in the past probably 2 or 3 years is because of their external debt situation. Like we saw the example of Sri Lanka, they defaulted on the external debt because the Fed got aggressive. They could not go to the capital markets to raise more debt. And same for Pakistan, they've got this external debt situation which is being controlled as of now. So I would say these 2 countries, Pakistan and Sri Lanka, have have historically had external debt issues. They still have those issues. But now they've taken the corrective measures, right? So, for example, the IMF has come in, they've got the funds from the IMF, and they have to do reforms to, make sure they get more funds from the IMF and make sure they have more confidence from external investors. So I don't see them going into one more kind of external debt crisis for the next few years, if at all. So, like I mentioned earlier, they're coming out of a crisis. We're not in, for example, in 2022, where now these countries are on an IMF program, interest rates are increasing aggressively, but now we're in a different situation. They've taken the corrective measures, inflation's coming off, the macroeconomic situation is stabilized. So overall, I'm not so concerned with the 3 to 4 year view on these markets, external debt situation.
And what about oil prices, high oil prices? What sort of impact does that have?
High oil prices, well, you can look at it two ways. One is, for example, if you see a major spike, oil going to say $120, $130 in a very short span of time, like we saw when the war in Ukraine began, that's going to be negative for not just Asian frontier markets, that's going to be negative for pretty much all the emerging markets in this part of the world, especially in Asia, because many of the countries are oil importing countries. Having said that, I think if oil, goes up gradually to about $100, I think many of these economies can manage it because, for example, now Sri Lanka is seeing an influx of foreign inflows, US dollar inflows through tourism and remittances. Same is the case for Pakistan, same is the case for Bangladesh. So the current account situation in these economies is much better. So, for example, current account deficits as a percent of GDP in these economies, Bangladesh, Pakistan, Sri Lanka, are about 1.5% to 2% of GDP, which is completely manageable. And in fact, that's very normal for any emerging market, which is a net food and fuel importer. So as long as current account deficits are managed between 1.5% to 2% of GDP, which is the case for these countries for the next 2 or 3 years, and oil goes to $100, they should be fine.
And what about earnings? Are they recovering also in line with the recovery in some of these economies?
Absolutely. So I think earnings bottomed out for many of our economies last year, and you're seeing a pretty strong earnings recovery, especially in Sri Lanka, where the first quarter of this year earnings have been extremely strong. You've seen a recovery in the economy, so therefore top line growth has been strong. But more importantly, because interest rates have come off, you're seeing that positive impact of low finance costs come into the income statement now, which is a big driver for profitability growth. I think the same thing is going to happen, say, in Pakistan with a 12-month view, and even Vietnam. I think you're going to see earnings recover as well over the next 12 months.
So let me ask you about Vietnam. I like talking about Vietnam with you because it's an interesting market, because we're seeing a lot of the global supply chains sort of being rerouted through Vietnam, but it's also been in the news this week as well, because it's got some political upheavals, which is a bit rare for Vietnam, isn't it? Because normally politically it's seen as quite stable, but there's a new president there. There's been a big anti-corruption campaign, which has removed not just politicians, but the heads of some quite big companies as well. What's your outlook for Vietnam?
Well, I think we are past the worst in terms of this political noise that we've seen in Vietnam. There were quite a few resignations, and like you mentioned, a lot of people were kind of fired from their jobs, and there were some arrests in the corporate world as well because of the anti-corruption crackdown. But on the political side, I think just recently, just a few days ago, they announced the new president and the new chair of the National Assembly. So you have 4 very important figures in the Vietnam political system. The party secretary and the prime minister, obviously they remain, and the president's post has been filled now, and so has the speaker or the chair of the National Assembly. So you've got that stability back now, at least from an investor's perspective. So I think that has been, I would say, sorted out for now. I don't see more kind of pressure on that front. Having said that, despite all this political noise that's happened, say, over the past 12 months and the anti-corruption crackdown of the last, in fact, more than almost 2 years now, you've not seen any impact on investor sentiment in terms of foreign direct investments. That's still pouring into Vietnam. So, for example, in 2023, Vietnam had its highest ever foreign direct investments coming into the country at about $23 billion, at about 5% of GDP, which is the highest in the region. So despite that, investors still have confidence in the manufacturing story in Vietnam. And even this year, foreign direct investments have been pretty strong. So at least on that front, it's not really hurting foreign direct investments. Yes, the stock market is looks at day-to-day news and therefore gets impacted by these events. But foreign direct investors take a more long-term view. They don't take a 1 or 2 year view or 3 year. They take like a 15 or 20 year view on a country when they invest $500 billion or $1.5 billion into manufacturing plant or manufacturing activity, and that's not really impacted Vietnam.
Let me ask you finally about your fund, the Asia Frontier Fund. Which market do you have the biggest weighting in?
Well, the weighting is pretty, I would say, balanced across the markets. Our biggest weight right now is actually Iraq, at about 14% of the fund, because the Iraq market actually has done very well over the past 18 months. Iraq fund was up about 110% in 2023, and it's up about 19% this year so far. So very strong performance in Iraq. And after that, we've got pretty much balanced positions across Mongolia, Vietnam, Pakistan, Sri Lanka, and Kazakhstan, about 10% each. So I would say these 5 or 6 markets are our largest positions, and we are looking to, and we also increased the weight to Sri Lanka in the past 12 months, because I'm quite positive on Sri Lanka's outlook for the next couple of years, and we could possibly increase the weight to Sri Lanka as well going forward.
And what's the PE of the fund now?
In fact, valuations across our markets are very attractive. The PE of the fund is about just 7.2 times.
7.2.
And that's, like I mentioned to you earlier, many of our markets trade less than 10 times. Only I think Vietnam is possibly the only market which trades at more than 10 times, with that 2 at 11 times, which is still a discount to other markets in the region. And more importantly, I think, like I said, you have very, very, very important factors coming together which should continue driving the re-rating. You have discounted valuations, which I mentioned. You have, monetary policy easing in our markets, and you have a macro recovery and earnings recovery. So it's all these positive trends are coming together, which should be very positive for our markets.
And how do you invest in these markets? Because I should imagine markets like Iraq, they're not easy to get into, are they?
Yeah, it's very good. That's a great question. So it depends on the market, but broadly, yes, it's not easy for any individual investor to just go start investing, say, in Bangladesh or Pakistan or Sri Lanka or Iraq or Kazakhstan or Uzbekistan. You have to have, a lot of paperwork involved, and a lot of, I would say, even bureaucracy involved in doing all this paperwork and setting up accounts and bank accounts and trading accounts in these countries. And therefore, it's not really easy to, invest individually in these accounts. And therefore, I think Asia Funded Capital therefore offers this a great platform for investors to get exposure to these markets. Having said that, yes, there's some frontier market ETFs around. I'll just say a few, 1 or 2. But the frontier market ETF would give you exposure to the global frontier market. So, for example, even to Africa, Latin America. If you're not bullish on those parts of the world, then I'm not sure if you want to own a frontier market ETF, which gives you exposure to those markets. And there are also some Vietnam ETFs, which does only Vietnam. But again, the ETFs kind of underperform the active managers, because many of these markets, Vietnam and especially Vietnam, the index is skewed only towards a few sectors and a few names. So the ETF invests in those names, and therefore if those sectors or companies don't perform, you'll kind of underperform an active manager. And that's exactly what's happened with our kind of fund performance. We outperformed the mean index for the past decade or so, and also outperformed the ETFs. So but I think the best way to access frontier markets is not through ETFs, but through active management.
Okay, well, Ruchir, thank you very much for coming in this morning and talking about that.
Thank you for having me.
That's Ruchir Desai, who is fund manager at Asia Frontier Capital.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening to Money Talk this morning. You can find more business and finance information from around Asia in my daily newsletter, which is at peterlewismoneytalk.substack.com. On tomorrow's programme, I'm joined by Francis Lund, the CEO of Geo Securities, and Sunil Kashyap, Director of Finbet. With a view from Australia is Toby Lawson, the CEO of Staten Partners. See you tomorrow.
Money Talk.